One of the most important concepts you're going to take out of this course is cash flow management. To be sure that you fully understand how changes in cash flow affect a business's economic performance, we've developed this podcast. Now, in this example, you're going to see how changes in customer behavior, how quickly customers pay their bills to us, is captured by a financial ratio, in this case, the accounts receivable turnover ratio, and how this change affects the firm's financial performance. The results of these changes are summarized in the table you see here. Now, the base case is the situation from the textbook that you find in Figure 14.4, 14.5, and 14.6. We will compare this base case, where 50% of our sales are for cash and 50% are for credit, to when all sales are for cash, no credit sales, and when all sales are on credit, with customers paying in either 60 or 30 days. As you can see from the table, this change has a tremendous impact on how much the firm needs to borrow. In the left side of the table, you see the maximum amount of borrowing. In the base case, it's $568,000. When the firm has all cash sales, we cut this number basically in half to $268,000. As we allow our customers to pay more slowly, in 30 days it rises to $871,000, and finally, when all of our customers are paying in 60 days, it means we have to borrow $1,163,000. We can also see whether the firm ever gets out of debt. On the right-hand side of the table, you see ending indebtedness. In both the base case in the book and the all-cash sales, we end up this 6-month period out of debt. But with 30 and 60 days, we find ourselves still $40,000 in debt with 30 days of people paying. And when people don't pay for 60 days, we find ourselves with $581,000. We also can see the impact on ending cash balances. In our base case situation, the book shows us that we go from $200,000 to $250,000. When all sales are for cash, we go from $200,000 to $446,000. And finally, as we go to all 30 days and 60 days, we find ourselves at the $100,000 minimum that we set in the problem. So what does this tell us? It tells us how these actions in the firm have a tremendous impact on the profits of our business. Cash flow matters. It's a terribly important matter. And it brings back a famous old management statement: happiness is positive cash flow. Now let's start by reviewing our original situation in Figures 14.4, 14.5, and 14.6 from the book, where the accounts receivable turnover ratio is equal to 8. We can convert this number to the average number of days it takes our customers to pay their bills to us by dividing 360 days per year by 8. This gives us 45. This means that our customers typically pay their bills on average in 45 days. We know from experience that credit sales are normally 50% of our business. Armed with this data, we are ready to build our initial cash flow budget. Let's start with the cash outflows as we see them in Figure 14.4. In the first row, we can enter the projected sales for each month using numbers from our marketing plan. To fill in the second row, we need two pieces of information that come from the assumptions at the top of the table: the inventory turnover ratio and the cost of goods percentage. In this case, the turnover ratio for inventory is 6. Items entering inventory normally stay there for 2 months. 360 days divided by 6, 60 days, 2 months before they're sold. From the cost of goods percentage, we know that whatever we sell for $1 typically costs us 75 cents. This means that what we are selling in February was actually purchased in December, and it cost us 75% of the sales revenue for February. We repeat this for each month. The accounts payable turnover ratio is 12. When we take 360 days divided by 12, the answer is 30. This means we pay our bills 30 days after we got them. So now we know that the things we bought in December are paid for in January. The overhead, the heat, the light, the rent, is paid in the month in which it's incurred, so there is no time delay. The two things we will be writing checks for each month are overhead and accounts payable. That is where we come up with the total that you find in line E. We can do the same thing here in figure 14.5 when we start looking at the cash inflows. First, we enter the projected sales from the marketing plan in line 1, just as we did in the previous table. In line 2, we write down the cash sales, which we know are half of the total sales for that month. In lines 3 and 4, we write down the money from the credit sales that's coming in, and we get some of the money from sales 1 month ago, and we get another pocket of money from sales from 2 months ago because of the 45 days, 30 and 60. The total amount of money coming into the firm is then the total of our cash sales, the accounts receivable sales from 1 month ago, and the accounts receivable from sales 2 months ago. We sum these in the last line of the table. Now we're ready to develop our first cash flow budget, and we'll do that by following the numbers in figure 14.6. The very first thing we do is enter the beginning cash balance in the upper left-hand corner, $200,000. This is the number that we will give you, and you can look in the assumptions to find the value that we're going to use each time. Next, we copy the total inflow numbers of cash flow inflow from figure 14.5, and we enter those on line B. We do the same for the cash outflows from figure 14.4, and we enter those on line D. Now it gets pretty simple. It'll be like balancing your checkbook. All we have to do is go down the first column and then take the last number in it and put it at the top of the next column to the right, and so on each month until we're all the way over to the lower right-hand corner of the figure. In column 1, December, we start with $200,000. We add $145,000 of cash inflows, which gives us $345,000 available in our checkbook. Next, we subtract the outflows for that month, $225,000, to get the net cash line, line E. Since this number is above the minimum cash assumption, we do not have to borrow any money in December. The ending cash value, $120,000, goes to the top of the next column to the right. And then we repeat this process for each of the next 5 months. When we're done with this, we find out that borrowing is required in January, February, and March. Repayments are made in April and May. At the end of May, we are out of debt, and our cash has increased by $50,000. Borrowing is required in January, February, March. Repayments are made in April and May. At the end of May, we are out of debt, and our cash is increased by $50,000. What's important to see here is the money to pay the loan came from the sales of the very items that the borrowing helped to finance. This is called a self-liquidating loan. Okay, now let's repeat the process under the assumption that all the sales are now for cash. Nobody buys anything on credit. Now, of course, since we're dealing with cash inflows, the cash outflows are the very same as we saw in figure 14.4. Next, let's look at the cash flows under this situation where there are no credit sales. In this case, now the cash inflows are very different because our sales for each month equal our cash sales. There are no accounts receivable because everyone pays cash. Total cash inflows equals sales. Now all the pieces are in place. It's now time to do a cash flow budget under the all sales for cash, no credit option. Now the cash flows here you see are very different from our base case in figure 14.6. We set it up the same way we did in 14.6, but the timing of the flows is now very different. We start with our initial cash balance of $200,000. We add the cash flows from the previous figure just as we did before, and we take the cash flows from the one we found 2 figures before just as we did before. Then it's a matter of filling in the chart just as we did in the last case. Now, the end results are very different. We see we need to do borrowing again in January, February, and March, but repayment is all completed in April. Here, the maximum amount we need to borrow is only $266,000 versus $568,000 in the original situation that you saw in figure 14.6. Now, let's do this same thing one more time, but this time we're going to operate under the assumption that all sales are on credit, nobody pays cash, and everybody who does take a credit sale pays us after 30 days. Just as we saw previously, the cash outflows are unaffected because the only change we've made is in the payment schedule of our customer. So we get the same cash outflows as we saw in figure 14.4. Now, what we're going to see here with all 30-day credit sales, we're going to get a very different idea of the cash inflows. Again, a huge change has occurred because there are no cash sales and all of our accounts receivable pay 30 days. And there are no accounts receivable in 60 days either. So we see that the $160,000 in sales in December appears on line C under the column for January. And the January sales of $192,000 in line A appear in February on line C, as there is a 1-month delay in receiving the cash from the sales the previous month. We can repeat this process through the rest of the months on the table. Now it's time to put together our cash flow budget under the assumption that all sales are for 30 days credit sales. So we will combine the figures just as we did before. Now, under this cash flow scenario, the firm needs to borrow every month except April. And at the end of the 6-month period, we find ourselves, rather than being out of debt as we found previously, we're still $42,000 in debt, and the maximum borrowing has now risen to $873,000. Our last scenario is to assume that all sales are on credit, again no cash sales, but this time we assume that our customers don't pay anything until 60 days after their purchase. And as we found before, and we look at cash outflows like the ones we see here, cash outflow is not affected by this change, so again we have the same figures as you saw in figure 14.4. Let's take one more look at the cash inflows under our situation with 60-day credit sales. And again, we see a radical change. There are no cash sales and no accounts receivable received after 30 days after the sale. Everything is received 2 months after the sale. So now in this scenario, the $160,000 of December sales are not received until February, and we see that on line D. The January sales of $192,000 in line A are actually received in March on line D. And we can complete this process for each of the months that are listed in the budget. Let's do our cash flow budget one more time. Now, in this case, we're going to develop a cash flow budget using the cash inflows and outflows for the 60 days on accounts receivable as we have calculated. Now, in the past, the borrowings occurred every month except April. In this case, with people paying 60 days after the sale, the maximum amount of indebtedness is now $1,163,000, and when the 6-month period ends, we still find ourselves in debt to the tune of $581,000. Let's try to summarize what we've seen here so far. What you see in front of you now is a summary of the changes in cash flows and the borrowing that we started with. Now, when we look closely at the effects of changing only the accounts receivable turnover ratio on the financial position of the firm, and we start looking at the table, we see the longer our customers take to pay us, the more money we have to borrow. We only borrowed $268,000 when everybody paid cash. This increases to $1,163,000 when we've extended everyone's payment period out to 60 days. You can also see the same impact on ending indebtedness. Our base case in the book with accounts receivable equal 8 and with all cash sales, we get completely out of debt. With 30-day sales, we go to $40,000, and finally when people are 60 days, our ending indebtedness, we're still $581,000 in debt. It also has a big impact on our ending cash balances. In our initial base case, we went from $200,000 to $250,000. When everybody was paying cash, we went from $200,000 to $446,000. But in our last two cases, where people pay 30 and 60 days after the sale, all we have is the $100,000 which we set as the minimum. Make sure we really see the impact of the things we've undertaken here. Let's step back for a minute and see what the effect of each of these scenarios is on the business's financial performance. If we assume they borrow their money at 8% and use an average balance for the 6-month period, we find out that we see some big changes in interest expenses. Again, let's start with our least cost approach, which is the all cash one. At this point, the interest expense, 8% for 6% on the average balance, is $1,787. If we go to the one in the book, the interest rate raises to $7,667. When people are paying all in 30 days, the interest basically doubles to $14,600. And when we go with everybody paying in 60 days, the interest expense now rises to $19,293. To give you some perspective on this, let's look at the impact on profit. Paying this interest, when it's all cash, lowers our profit 1.6%. Not a lot. When we look at the one that was in the book, our base case, we see a 6 2/3% drop in profit. And when we go to 30 and 60 days, we see a 12 2/3 and a 16 2/3 profit drop. They're rather significant. If we make the assumption that the firm, like most companies, operates on a profit of 5% of sales, you can see in the last column the impact on profits. And what you see is what kind of sales increase are needed to compensate for this interest payment. In the all-cash example, sales would have to go up by $35,740. With our base case scenario, it goes up more than 5 times. It would take $153,340 in sales to make up for this interest expense. In the 30-day case, it doubles again almost to $292,000 in sales to make up for this drop in profit. And finally, with the 60-day situation, sales have to go up again by $385,860. All of these have a significant impact on the firm's financial performance. And all we did here was change the accounts receivable turnover ratio. But you can do this with just about any of those financial ratios we have in the book. These ratios are very powerful instruments, and they capture significant changes in business financial performance. And they do this because they work and track serious variables that have big impacts on the firm's long-run financial performance. The bottom line from all this is that cash flows matter, and once again, happiness is positive cash flow.